Hello, everyone, and welcome to the Kentucky Small Business Development Center's weekly webinar. For almost 40 years, the Kentucky SBDC has assisted emerging and growing businesses by providing the professional expertise, tools, and information necessary to make sound business decisions in a complex and ever-changing marketplace. We do this at no cost to you, thanks to the U.S. Small Business Administration, who co-sponsors our program and is then administered by the University of Kentucky, who then partners with regional universities, colleges, and local economic development agencies. As you'll see on the screen, we're part of a national network, which is America's SBDC, which has over 1,000 centers across the nation. To learn more about us, visit kybizhelp.com. There you'll find additional resources to help start, fund, and grow your business. To request personal assistance, you can email us at info@kybizhelp.com or call 1-888-475-7232. So a recording of today's event will be made available to you later today. So if you have any issues with the audio, you need to step away. You'll have access to the whole presentation. If you look to your right, you'll see a chat feature that you're able to ask questions there. If you'll post those, we'll answer those towards the end of the presentation. But if you want to go ahead and test that out now, just say hello and tell us where you're joining us from today. I'm Janet Flom with the Louisville Small Business Development Center, one of 13 centers throughout the Commonwealth. And with me today are my cohorts from Louisville, Dave Etkin and Tony Sears. Good afternoon.
Hello, Janet. It's a great day.
Hi, Janet. Hi, Janet. How are you?
I'm good, Tony. How are you today?
I'm great, thank you.
So we've got a great day planned today. And again, I'm Dave Etkin. I'm the director here at the Louisville Small Business Development Center here in beautiful downtown Louisville, Kentucky. And we have gotten a lot of requests to have our guest back today. She's been so gracious to come and see us on our show a couple times already. And Erica Horn, who has about 30 years of professional experience. She's both a CPA and an attorney, and that's definitely double trouble in my book. She's an expert in tax law, and since the beginning of the COVID-19 pandemic, she has been Dean Dorton's go-to guru for all things PPP. And she focuses the majority of her time advising clients on state and local tax issues. And she has a distinction to have saved her clients billions of dollars in taxes based all through her expertise. And Erica, there's a lot going on in the world of PPP, and we're glad you're back here to help tell us where we're at now and what we can expect going in the future and what we need to do. So, Erica, I want to turn it over to you, and we'll just go ahead and get right started and get into it, because I know I'm going to have a bunch of questions, and I know everybody out there is going to have questions too. So please put your questions in the chat, and we'll get to them as many as we can as time permits. So just put your chat question, and we'll ask Erica. So Erica, what are you going to tell us about Paycheck Protection Program loans today?
Well, here we are, Dave, 6 months later, and we're still mired in Paycheck Protection Program questions and uncertainties, and there's a lot. One of the fun parts about putting this presentation together was that I've got some slides that show you why your head has been spinning while all this has been going on. So here's what I hope to do today. I want to provide you an overview of the program, and let me say this at the outset. This is a good program. The administration of the program has been troubling for all of us. It's why you're on the phone. It's why I've been busy, or why you're on the webinar, why I've been busy. But the idea behind it and getting cash into the hands of small businesses it was a great thing to do. So to the extent that I think many of you already know that I can get a little snarky or humorous, to the extent that I do that, that's out of frustration, not with the program itself, but just to the way it's been administrated. And I don't blame that on SBA. I mean, everybody in this scenario has been placed in a horrible situation, everybody in COVID-19, and has had more work than they can do. So it's personal, guys. It's personal. So I want to talk about that. The two biggest problems when we get to forgiveness that I have had, both personally doing forgiveness applications on behalf of clients and answering questions for others, revolve around the FTE calculation and owner's compensation. And so we're going to do a little bit of a deep dive, especially into the FTE calculation, less so into the owner's compensation, because there's good written guidance on that for you. And we're going to talk a little bit about that guidance, and then I am going to do my best to answer your questions. So that's what I hope to do today. So here we go. I've got 3 slides that take us from just right at 6 months ago, March 27th, when President Trump signed the CARES Act. The last action by SBA or anybody related to the loans was on August 24th. So we're almost a month out from that. So it may be that it's forever in my mind, where were you on the day that the CARES Act was signed? I may always remember that now. Instantly, they began on March 31st, they put out the very first draft of a loan application form. Boy, that was fast. And then, just a little over 2 weeks later, the program runs out of money. SBA has to stop. It takes a little over a week. President Trump signs a bill to add more money. And then one of the more earth-shattering events in this process has been this joint statement by Treasury and SBA when they said, if you made this certification, that you needed the money because of uncertainty for your business, you better have meant it. And by the way, we're gonna audit all loans over $2 million, and we're gonna randomly audit loans under $2 million. That was the end of April. It took SBA a little bit to start gearing back up. The next probably big event from my point of view, as somebody who's trying to help people, was when the forgiveness application was released in May. And then I've got my dates out of order, guys. Dog nabbit. That's right. President Trump added, Congress and President Trump, they have the Flexibility Act that added the 24 weeks. So you no longer had to try to spend all your money in 8 weeks, which most businesses were finding nearly impossible. It was just about a month later that they revised the forgiveness application and also came out with an easy form. And then President Trump signed a law extending the program from the end of June, from June 30th until August 8th. You could apply for the program through that time period. The Flexibility Act did some other things in addition to the 24 weeks, and we'll look at that shortly. The first part of August, SBA and Treasury were busy, so they came out with 23 frequently asked questions on forgiveness. And I'm laughing because as a CPA, I'm a member of the AICPA, and they've been doing these weekly town halls where they talk about the PPP loans, and they had been promising these 23 FAQs on forgiveness since, I would say, mid-May, right? Very shortly after the forgiveness application came out. So we got it in August. There was your last day to apply for the loan. August 10th, SBA begins accepting forgiveness applications. You all might have been or might be in a hurry to file. A lot of banks weren't accepting forgiveness applications until shortly before that August 10th deadline, or opening line, instead of a deadline. The day after that, they issue 3 more forgiveness FAQs and 2 general FAQs, and we're going to talk about that. And then an IFR on how you can appeal lender and SBA decisions We are not going to talk about that. You can read that one if you'd like. They'll be in your materials at the end of the day, Ryan said. And the forgiveness IFR, which turned out to be painful because of related party rent, but otherwise a big kind of nothing, came out on August 24th. So that's just a little background. So we have had lots of guidance issued, and it has come in many different forms. So typically with government agencies, you get the government agency gets the statute, they're supposed to interpret the statute, and then they produce regulations. SBA calls them rules. That's fine. Typically, there's a process where the regulation or the rule comes out, and you have input from people who are impacted, and then that rule could be revised and put back out again. And there's a little bit of back and forth, but there was no time here, so they issued interim final rules that were final on the day that they issued them. Strict adherence to the law has not been a priority in the implementation of this program. So we got forms. Like I said, the very first form was on March 31st. And I don't know about you all, but I have been on the borrower side of all this. Lenders were getting forms and their own instructions throughout this process too. The loan application first came out on the 31st. It was revised the 2nd, the 3rd, June 11th, and June 12th. So those dates beside there are dates of revisions. Some people had completed their application, that March 31st application, and then when the window opened on April 3rd, they're like, do we have to do it again? And some banks said yes, and some banks said no. 24 interim final rules for borrowers and lenders, a bunch of frequently asked questions. There are some things out there called procedural notices that apply to lenders. That's where I first found out when SBA was going to start accepting forgiveness applications. There's an incredibly important document that came out a little later than we needed it, called How to Calculate Loan Amounts, that came out around April 24th, was updated around June 26th. And those were the questions that everybody had been asking in terms of how do I complete this borrower application? And for example, one of the big questions was, do I include independent contractors? And this How to Calculate Loan Amounts document said no. And then later they came back and said, well, maybe you could. And then there's other things. And I was surprised to learn that SBA is not the only one who was putting out guidance. So here's the USDA. They put out some frequently asked questions for farmers on April 25th. So we have forgiveness FAQs and general FAQs. And when we first started getting frequently asked questions, it was those general frequently asked questions. And then we have these FAQs for faith-based organizations. So that's another set. We have affiliation rules. If you go to Treasury's website, you'll see all these things on there. I don't know. I know as a lawyer that statutes and regulations have the force of law. I don't know about all this other stuff. So if we rely on it, are they going to say, well, you couldn't rely on that because that didn't have the force and effect of law? Or, you say, hey, that was all we had. Or my thought would be that they're going to rely on it. And, I guess how confident we are on some of those questions depends on how the types of confidence and experiences we've had with government. So here, in addition to all that, so you saw a bunch of dates on those first 3 slides, here are more dates and the perfect example of why our heads have been spinning. So there are now a total of 51 quote unquote general in the general category FAQs, and here are all the dates on which an FAQ or two or more were issued. I couldn't finish writing an article to send, for Dean Dorton to send out before something had changed or something was new. I was just perpetually behind. Then, more recently, we got loan forgiveness FAQs. There are 26 of them. They're broken down into 5 categories. They were issued on August 4th and the 11th, and then we got this IRFR on forgiveness on August 24th. So there's a link at the very end to a timeline done by a law firm that I think goes by Hunton AK. And basically from March 27th through, I think, August, well, actually, they've done something through September. If you take the FDIC, the other bank regulators that the lenders have to pay attention to, you take SBA and Treasury and IRS and USDA, there have been 90 actions related to PPP loans since they started, which, is a lot in 180 days. So the program closed on August 8th, and I thought this was sorry to be the nerd that I am, but I thought this was interesting. So between April 3rd and August 8th, SBA made 5.2 million loans for a total dollar amount of $525 billion. Of that, Kentucky companies got about 5.3 billion. The average loan size is 101,000. The number of loans under 150,000 is 4.6 million out of the 5.2. And when the program closed, there was $134 billion left. So you have heard a lot of talk, perhaps, that if your loan is under $150,000, then maybe your loan is going to be automatically forgiven. And all you have to do, perhaps, is sign a piece of paper with all the certifications on it. This slide shows you why that is important to both lenders and SBA. Lenders don't have any chance, nor does SBA, of reviewing forgiveness applications for 5.2 million loans. And the time frame is the lender has 60 days from submission of the application to take an action, and SBA has days. We about starting August 10th, whatever the date was when they started taking the forgiveness applications, and fast forward 150 days, all of the loan applications, forgiveness applications submitted in that time period, which I would say, I don't know how fast people are going to do it, but let's just say it's half this number. Let's say it's 2.5 million, that they would have to process all of those, 60 days for the bank, 90 days for SBA. I don't know. If you draw a line and say if it's less than 150, then that leaves 600. I can't do the 5.2 minus 4.6 million. So I think I'm scared to even say what the math is on that. I think I know, but I don't want to embarrass myself. You guys can do the math. Somebody's got a calculator. Anyway, you can see the huge difference that would make. For a while, everybody thought that that 150,000 thing was going to go through quickly and easily. Secretary Mnuchin said last week that he would be in favor of loan forgiveness, kind of like auto forgiveness, at 140,000 and under. I don't know where the 140 comes from. And then people have been saying that they thought if it was 150, people who should know that there might be some strings attached. Now, I don't know what those strings would be. So we're just going to have to wait until there's some sort of congressional action to see how that auto forgiveness thing works out. Okay. Here's what you need to know. If you haven't filed a forgiveness application or prepared a forgiveness application, the first thing that you want to know is, does the lender, the bank, where they're going to take the forgiveness application, do they have a portal? Are they using a software where their borrowers go in and input information and upload documentation and submit it to the bank? Or are they doing the good old hard copy or email me a PDF sort of thing? The answer to that question could slightly change the way you approach your forgiveness application. If your bank is using a portal, then you want to take a look at the portal before you get started, so you can kind of have in your mind how to organize your work. And then if it's the plain old hard copy way, well, that's SBA with the forms has organized that for us in a sense. There's been a rush to apply for forgiveness and not to use the 24 weeks. So when the Flexibility Act extended the time for using your money to 24 weeks, a lot of people, very interestingly, a lot of people used up their money between 10 and 12 weeks. Why does that make sense? Because the loan amount was based on 2.5 times, 10 weeks roughly, of your average compensation. So most people were using the money up around 10 to 12 weeks. SBA said, when you use all the money, you can apply for forgiveness. So you don't have to wait till the end of the 24 weeks. We are now at the end of some of the earliest borrowers' 24 weeks. So if your loan was dispersed between, say, April 5th and April 15th, and those first 10 days, then your 24-week period has ended. And, as every day goes by, more and more borrowers will have that covered period end. It is advantageous to the borrower to go as many weeks as it takes and to use only cash compensation for forgiveness if you can do it. 3 reasons for that. Number one, that you have all that data. That's the easiest data to calculate. You have to have 60% of your forgiveness amount made up of that anyway. If you go that route, then you can just upload your payroll documents, your 941, your state unemployment return, your bank statement, and you're done. Perhaps, primarily. If you have cash compensation of employees and you don't have to use owner's compensation, then you don't have to worry about all the messiness that you're going to see or that you've already encountered when it comes to owner's compensation, and you're not exposing that owner to the additional risk of this personal information being out there. Third, and perhaps most importantly, it will theoretically expedite the review process by both the lender and SBA. If all they have to look at is cash compensation, they don't have to look and see if your health insurance statements include only the employer portion, Erica. They don't have to look at all your utility bills to make sure they're in the covered period. If you can just use cash compensation, that is the way to go. The next way to go is see if you can use the easy form. And to use the easy form, there are 3 criteria for that, and we're going to come to that in a minute. And one of the questions, because one of the criteria is that there's been a loss of business activity, and there's not real clear guidance around what that means. And then the question that, if any of you all have the answer to this question, like if your lender has told you the answer to this question, or the last question on my slide there, or you've talked to, oh, I got to tell you guys something. So around April 6th, 7th, 8th, very early on, I sent the SBA a general message with a list of questions. I got an answer last week, which was fantastic. Um, and the answer referred me to a lender relations specialist. And I bet they didn't even have lender relations specialists, or not as many of them as they do today, at the time that I sent those questions in. So if you have talked to a lender relations specialist, or your bank has, and you know the answer to this question, shout it out. So can a borrower spend itself out of a reduction in forgiveness amount based on either the salary and wage reduction or the FTE reduction? We're not going to go through a forgiveness application because A, we don't have all day, and B, you would want to choke me, and I'm still interested in living. But if you do, you will see that if you use, especially with the 24 weeks, you can put enough compensation, or actually forgivable cost. It doesn't even have to be compensation. You can put enough costs on your application that it will erase any reduction. And that's how the form reads. I mean, that's how the form works. Now, whether or not that was intentional or unintentional, I don't know the answer to that. There is some thought, and I really hope I'm wrong about this and my colleagues are wrong about this. There's some thought that you cannot start your forgiveness application with a number that is larger than your loan amount. There is some language that supports that approach. And if that is true, then you're not able to make that FTE reduction or salary and wage reduction go away just by spending. This became more important than ever in two scenarios to my mind. One, when they kicked out related party rent, and we'll talk about that in a few minutes. And two, when you are an owner of a business that was indirectly impacted by a business that had to shut down because of a government order. So let's talk about that. Well, we'll come back to that in just a second. Okay. So here's the details of the Flexibility Act before and after. So we remember before, loan term 2 years, 1%, 8 weeks to spend, SBA, or actually treasuries. I don't blame anything on SBA. Treasuries, 75% threshold, principal and interest deferred 6 months. The Flexibility Act for borrowers starting on June 5th and after, the term is 5 years, same 1%, 8 or 24-week covered period, 60% threshold, principal and interest deferral period. I'm not 100%. Here's what we think it is. We know for sure that you don't have to make any payments on the loan until SBA lets the lender know that how much is going to be forgiven or whether it's going to be forgiven. And the language of the regs and the statutes and all the guidance is all over the place about interest and accrued interest. But we've got a while. That's the bottom line there. If you borrowed before June 5th, you had to negotiate with your lender, or have to negotiate with your lender for the 5-year term, and you can opt for 24 weeks, but you don't have to. The 60% applies to you. Okay. A little bit about the long and the easy of Form 3508. So in the materials that you'll get at the end of the day, or I think you can see them. So there are two forms. There is a Form 3508 and its instructions. And there is a form 3508EZ. Don't be fooled by that. And its instructions. I think that the 3508 long way is seven pages with 4 pages of instructions. Anyway, it is physically longer. It has these 5 components. It has a loan forgiveness calculation form, which is really it's the face page of the application. It then has a page where you swear to tell the truth, the whole truth, and nothing but the truth. It has a Schedule A and then a very handily named Schedule A worksheet. Borrower demographic information. There is a form that is optional. It applies to owners, so you answer questions about owners. The EZ has the face page forgiveness calculation form. It's obviously a combination of the numbers 1, 3, and 4 for the long form, and then it has the certifications and once again the optional borrower demographic information. The easy form is good, but I recommend it. But I will tell you that you almost have to do the long form to have the documentation and the numbers you need to put on the EZ. So using the long form is a good way to organize your work and preserve your information. Other than this bullet point right here, documentation, submit, and retain. The instructions are very specific on the documentation that borrowers must submit and that they must retain. Retain for 6 years. Wow. In addition to what the application forms tell you, I would want to keep an executed copy of my actual application. I would want to keep naturally all of the supporting documentation that I sent. Any worksheets, spreadsheets, chicken scratches that you did while preparing your application. If your loan is $2 million or more, the reasons for that you qualified for the loan, you want all that in a file that's backed up that you can't lose in case you ever need it. No documentation, no forgiveness. My friend John is fond of saying, just because I didn't make slides out of it doesn't mean that it's not there and that it's not important. It is. There's just more important things today for us. So here are the criteria for using the EZ form. Again, because you all of this, but it's attractive, right? It's attractive. So if you are self-employed, whether that means you're an independent contractor, a sole proprietor, you have your own single member limited liability company, and you have no employees, then you can use the EZ. Now, these criteria and these references to boxes are in the instructions to the EZ, and they are on page 1 of the instructions. And literally, there's 1, 2, 3, 4, 5 paragraphs, and they have little lines, squiggly lines between them. Well, they're dashes. And then a box. So box 1 is for this self-employed individual. Box 2, you can check box 2 if you had no reduction in salary and wages in excess of 25% and no reduction in the number of employees or average paid hours of employees, both of those requirements between January 1st and the end of the covered period. Now that any type of layoff, any type of slowdown, any type of anything like that will kick you out. But if you were an engineering firm and things kept going along for you just handily, and you had 14 employees on January 1st and you had 14 employees every day thereafter, and your covered period ends today, and you didn't reduce anybody's wages in excess of 25%, in fact, you didn't reduce them at all, then you can check the second box. If you check the second box, and I don't think the banks know this part yet, you guys, but if you check the second box, it does say in the instructions for the documentation that you have to provide supporting documentations for the FTEs on January 1st and the end of the covered period. Well, what if you're applying before the end of the covered period? Because SBA said you can apply before the end of the 24 weeks. You don't have to worry about that. And they have a procedure that if you had a salary and wage reduction, they tell you, now, if you had a salary and wage reduction, you have to project it through the end of the 24 weeks, and here's how you do it. When it came to FTEs, they didn't say anything. So the AICPA has been waiting and saying, well, we don't know what that means. And so you really can't apply for forgiveness yet. We have interpreted that to mean that you had to have the same number of employees at the time at which you filed your forgiveness application. And according to the AICPA, and that's just been my best source of information, guys. That's the only group that I belong to other than the Bar Association who really doesn't care about any of this yet. They need it all to go wonky, so they have lawyerly things to do. That has the governmental relations resources to be in touch with folks on the Hill and SBA and Treasury and all of that. So that's why I keep referring to them. So they announced last week that a lender relations specialist had announced that, yes, for FTEs, you use whenever it is that you're applying. That makes sense. So you would have that's a calculation you weren't expecting. You never heard the date January 1st before, and you weren't expecting to do 1 week that includes the last day of your covered period. So the way we've interpreted this, submit FTEs for 1/1, take the payroll for the pay period that includes January 1st, 2020, the hours paid for that week per employee, and divide by 40. You're going to see that in a few minutes. And then the same thing. If you're getting ready to file, you think you're going to file on September 10th. You take your pay period that included September 9th, assuming you know. So there's a little bit of a problem with this, as you can see, a little bit of a timing issue. And calculate your FTEs on that day. That's box 2. Box 3. No salary or wage reduction and the loss of business activity because of compliance with a government order. Government, they define to be state, local, federal. Initially, it was just federal, and everybody was like, and then they came out and said, okay, any government order. We referenced a minute ago, what is this loss of business activity? It could be gross receipts, right? Gross sales. It could be a slowing of accounts receivable collection, possibly, or an aging of accounts receivable. It could be net income, gross profit. You want to document that, and that's one of those things that you retain as opposed to submit. You submit the government order, but you don't submit the documentation of your loss of business activity, strangely enough. So I mentioned the group that is indirectly impacted, the group of businesses that are indirectly impacted by a government order. So let's take a food wholesaler as an example. We all know that restaurants have been directly affected by government orders across all the states to close. As a result, food wholesalers lost all demand for their products. They didn't have to shut down. That wasn't what happened to them, but because their customer had to shut down, it kind of happened to them. That scenario does not seem to be covered by this box, because I don't know what government order the food wholesaler would submit. You could argue that they could submit the government order for the restaurants. I'm not sure that when you read the statute that it goes that far. Another example could be a hospital. So hospitals stopped doing, or a surgery center, all elective surgery, right? Stay with the hospital. And maybe they had a certain law firm that worked on all of their malpractice cases. When they had to shut off all of their elective surgeries and a lot of other stuff and didn't have that stream of revenue, they may have told the law firm, stop, don't touch a file, don't do anything, we can't pay you, just hang on, hold still out there. Well, now you've got 15 lawyers and a 45-person firm, for example, that doesn't have anything to do. How long can you pay those 15 lawyers to twiddle? And the lawyers were indirectly impacted by that government order on the hospital, but I don't think that they can check box 3. Again, if somebody has heard it differently, I am open. Open. All right, everybody get a big drink of water before we start on FTEs. Ready? Okay. Erica, what is an FTE? A full-time equivalent employee. Oh yeah, I knew that. A full-time equivalent employee, and in my business, that's 37 and a half hours a week. Is that what SBA uses? Oh, in my business, it's 35. No, SBA said finally, after we lingered forever, and we thought it would be 32 because SBA, I think we thought it would be 32. There was some number we thought it would be because it's the same number that SBA uses in other areas, but it turned out to be 40. Well, does that mean that somebody that works 37 and a half hours is not a full-time equivalent employee? Yes, that's what that means, even though that's your full-time. Okay, Erica, why do I care? Well, you only care if you had to reduce your workforce in some way, lay off a certain part of the manufacturing facility, give everybody a day off a week, unpaid, do something during the worst part of the business slowdown related to COVID. There is a reduction in the amount of forgiveness that you can get for a PPP loan if there is a reduction in FTEs when you compare the covered period to the chosen reference period. You have 3 reference periods to choose from, only 2 unless you're a seasonal employer. If you're a seasonal employer, you have 3. For non-seasonal employers, you have January 1st through February 29th, 2020. And I will tell you that that's what most people are using, because I think they're doing that because it's shorter, because the other period is February 15th through June 30th, 2019. And when you see what you have to do for these periods, you'll be like, yeah, no, I want to use that January 2020 period, January, February. But actually, folks, you have to, you really need to do the calculation for both, because you want to pick what's best for you. And the only way to know that is to strike out and calculate those numbers. For a seasonal employer, there is another option. It's a consecutive 12-week period between, and I don't have it. Hang on. Let's see how fast I can get there if I can. I want to say May 15th through September 30th, May 1st through September 15th. So 12 consecutive weeks between May 1st and September 15th of 2019 for seasonal borrowers. Okay. So what is this FTE calculation? What is it that I need to do? And how is it that I'm going to end up, if I have less FTEs, with less money? Well, to calculate FTEs, the language is terrible. There are lots of ways. I'm going to show you one way. I have seen payroll providers. If you all have a payroll provider, and they can print these reports, these CARES Act reports, where they all have different names for them. I've got a friend on the phone who's in the payroll, third-party payroll business. Get him to print that report for you. Use the full 24 weeks period. Nobody's going anywhere. And your life, have some wine or some bourbon, whatever you want. I mean, life is much easier under those circumstances. You might have to tweak it a little bit, but that's out there. So I've seen the way payroll providers do it. I've seen the way that the banks are doing it inside their portals. I've seen the way individual businesses, including our own, Dean Dorton, has done it. And there are variations on a theme out there. So I'm going to show you the way that Dean Dorton has adopted that it's as right as anybody else's. Okay. So it's the average number of hours paid per week per employee divided by 40, rounded to the nearest tenth. We're gonna see that momentarily. Capped at 1. So if somebody works more than 40 hours, like in this example, 48, they only get a 1. And that the average number of hours paid per week divided by 40, rounded to the nearest tenth, that's called the detailed method. SBA has also offered up a simplified method. If an employee worked or was paid more than or equal to 40 hours, they're a 1. 39 and a half and under, they're a 0.5. So typically in a 40-hour week, you and I would think 20 hours a week would be a 0.5. 38, well, we have to get down to a number that doesn't round up to 1, but 35, 30, something like that is going to be a 0.5, and so is 2 hours or 10 hours. It yields some very interesting results. Okay, 40 into this, according to this little clock over here. And so I'm going to have to do this quicker than I really wanted to. But hopefully you have enough material between the forms, the frequently asked questions, the IFRs, all you'll get at the end of the day to help you, plus the slides to help you with it, okay? So here are the steps, and these are the steps actually that are going to get us to any reduction. And okay, I'm ignoring reductions related to salary and wages. All right, I have that other than a vague reference here or there in this presentation. That is nowhere in here. 2 reasons. One, I haven't seen it come up in all of the ones that I've done so far. And two, there's only so much time in a day, and there's only so much space in my brain. And there's three, there's a lot of guidance on that one, examples on how to do that. So we're going to pretend like there were no reduction in salary and wages, and we're just going to look at FTEs. So step one, calculate for each employee the average number of hours per week that they were paid. Then calculate the FTE of each employee for each of those periods, each historical reference period plus the covered period, and at the very end you'll see there's some other periods. If you're going to do the short form, the easy form, you've got to do January 1st and the end of the covered period. Next, you want to see why there are changes in your FTEs between your reference periods and your covered period. Did somebody go on maternity leave? Did somebody retire? Did somebody quit? Did somebody get fired? All of those things are important things to know. Did you lay them off because of lack of work and didn't bring them back? All of those things are important to know. So those things are called FTE reduction exceptions. And then what this step 4 really should say is determine the amount of the FTE reduction exception. So you're going to see that in a minute. You're going to see one amount in the reference period, a different amount in the covered period, and the difference is the amount of the FTE reduction exception. You're going to add those FTE reduction exceptions to the covered period FTEs. Then you're going to calculate the magic reduction quotient. Average FTEs for the covered period over average FTEs for the reference period. Here we go. This is ABC Company, XYZ, Widgets Inc., Widgets LLC, whatever you want to say. They do their payroll weekly. Erica, what if they do their payroll bi-weekly? Your thing here says weekly. I say divide by 2, guys, but there's lots of ways, as I said, to work all this out. 8 employees, including 1 owner. Between the reference period and the covered period, 1 employee voluntarily reduces their hours by 20%, and 1 employee retires, i.e. quits. They got a loan and the amount of the average loan of $101,000. 8 employees, 1 voluntarily reduces their hours, 1 retires, weekly payroll, $101,000 loan. Step 1, calculate the average paid hours for each employee. What if you have 350 employees? Then you hope you have a third-party payroll provider or somebody with mad Excel skills, or that your bank has one of those portals where if you sit down and put all of this information in there, then it will spit out the answers. There might be, I actually had a client ask me, there's probably stuff on the internet, guys, calculators that do all these things, and that's fine and that's good. If I were going to use one of those, I would want to know what the formulas behind the calculations were. So, because you're going to swear that it's correct, not that software provider or person behind that link, whatever it is. I used the 2020 reference period and an 8-week covered period. Employee A worked 40 hours a week. Every week, and that covered that reference period 1/1 to 2/29/20 is actually 8 weeks and 3 days, which is also 8.6 weeks. You add up all the hours and you divide by what I divided by here is the number of weeks, 8.6 weeks, and look, surprise, average paid hours per week of 40. Okay. When we got to the covered period, something happened between, let's say, February 29th and the first day of the covered period, let's just pick April 15th. And employee A is now only working 32 hours a week. And so the average paid hours for employee A falls to 32. This is the employee that voluntarily reduced their hours by 20%. And that's okay. Now, the numbers are never this even, right? It's 41, and then 1 week it's 38, and then somebody might have had to take some unpaid time, and it'll be 20. And so this is a simplified example, hopefully for you to get the picture. Now, we got to take every one of our employees, and then for the reference period and the covered period, figure out how all that translates to FTEs. Well, why did I say in the slide before that employee A's average paid hours in the reference period was 40, and here it says 38? That's just a mistake on my part, guys. Sorry about that. Because 38, when you round up to the nearest tenth, gets you to 38 divided by 40 gets you to 1. It's still a 1. So that's what is going on here. It's the average hours paid that you just did on the prior spreadsheet for every employee. Here they are, A, B, C, D, E, F, G, H. And for a week, that number divided by 40, rounded to the nearest tenth, is the detailed method. Okay? Look at that number, and if it's less than 40, then it's a 0.5. If it's 40 or more, it's a 1 under the simplified method. A couple of things to note. Different payroll providers will show somebody who's making a salary. They might show them as a 40, or they might show them as a 0. It doesn't matter as long as it's consistent in both the reference period and the covered period. Okay. The owner, same thing. In some ways, the owner doesn't count in the FTEs. It doesn't matter. I would just zero out the owner for the FTE calculation. When you are doing the long form, employees, there's 2 tables. Table 1, PPP Schedule A worksheet, Table 1, and then Table 2. Table 2 are employees who annualized in any one pay period, listen to this, in 2019, more than $100,000. Any employee who annualized in any one pay period in 2019, more than $100,000. Bonuses at July 1st could land somebody on Table 2. Everybody else that's employed during the covered period goes in Table 1. Owners go in none of the above. Table 1 has the cash compensation for every employee, the FTEs, and the salary and wage reduction. Table 2, because people who made annualized in any one period more than $100,000 in 2019, it doesn't matter if there was a salary and wage reduction, only has the employee, the amount of compensation for the covered period, and the FTE. The form, the way it works is you take the Table 1 FTEs and the Table 2 FTEs, and they flow through the form, and those 2 things get added together. The compensation for the owners go on a separate line on the Schedule A. I think it's line 9 or 10. And so they're not included in either of those tables. So that's why I would exclude them here. Just zero them out. Okay. If we do the math, and I've done it a couple of times, trying not to embarrass myself, despite the 38 for employee A there, we've got 5.7 FTEs for the detailed method and 5 for the simplified method on 8 total employees during that time period. Covered period. We do the same thing. We've got the 32 this time. I got it right for employee A. Divide by 40. She's a 0.8, or for the simplified method, a 0.5. G, retired. So she's 0 all the way, or he's 0 all the way across there. The number of employees, therefore, is down to 7. Why do I care about the number of employees? Because I can check box 2 if my number of employees are the same at January 1st and the end of my covered period. And that's why I was looking at that number. They're not. So can't use the easy in this particular case. Now, what do I do with all of these crazy FTE numbers that I've now calculated for every human being that lives? Is how I feel about it. You compare them. This is a quick comparison. And I said before step 3 is looking at FTE reduction exceptions. So I shouldn't have said you compare them now. But if we stopped here, if we did not do the FTE reduction exception, see the third line, reduction quotient, that's the covered period divided by the reference period. On our $101,000 loan, the forgiveness would be reduced by $30,000, basically, which is a lot. So the forgiveness will be $70,700, or because of rounding, blah, 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 $70,877.19. But look, here are the FTE reduction exceptions, okay? And in the interest of time, I'm not going to read them to you. Please know, and they are in the frequently asked questions, and they're laid out well. Please know that you need written documentation for almost, if not all, of this, all right? One quick note there, it applies to all employees. So even if you had somebody that makes more than $100,000, if they qualify for an FTE reduction exception, that's fine. Where do I put these things if I'm trying to fill out this form? There's actually a little tiny square at the bottom of table 1 on PPP Schedule A worksheet, and that's where you put your number. Here's how it works. So here's our FTEs for the covered period under the simple and the detailed method. The exceptions. A voluntarily reduced her hours, or his hours. Remember that in the reference period, they were a 1. In the covered period, under the simple method, they were a 0.5. That means we get to add back to our covered period the difference, the 0.5. We did not hire anybody to take up the slack as a result of A, dropping their hours, okay? Employee G retired. They were 1 in the reference period. They're 0 in the covered period. Under either method, simple or detailed. They were not replaced. If they're replaced, then it doesn't count because those hours are in there somewhere. So you get to add back a 1. Look at your hours now. So we are back to 5 FTEs for the covered period when we add back the FTE reduction exceptions using the simple method, and our eligible forgiveness is now $101,000, the amount of our loan. We don't do quite that well using the detailed method, so what this tells you is that you would want to use the simple method. You have to use the same method throughout. You can't mix apples and oranges. And you have to pay attention and make sure you don't shoot yourself in the foot, or whatever the right analogy would be, by not counting those. Sometimes you won't need them, and so you just don't want to go through the. But then you. How many minutes do I have to do this for, Erica? Perhaps this many time periods. I know it's exhausting. Why so many times? I don't know. That's just how it came out. Okay, owner's compensation. There are limits on owner's compensation. You have to read the forgiveness FAQs that came out. They're now dated August 11th. Number 8 gives you the details for every type of business and therefore every owner employee, and exactly how that owner employee is to be limited in terms of compensation. So the first question is, what is an owner employee? This cracked me up. When we finally, so that was one of the questions that was up there. What exactly does that mean? And the answer is an owner who is also an employee. Why didn't we know that? I mean, it makes perfect sense, right? Then really late in the game, August 11th to be precise, they said, oh, actually, no, that might be August 24th. That might be in the IFR. S and C corporations, if ownership is less than 5%, then you don't get counted as an owner. You just get treated as a normal person. Here is cash compensation across all businesses. Here are the limits. It's, if you're using the 8-week covered period, 850 seconds of 2019 compensation. So you have to have that owner's W-2, K-1, Schedule C, whatever it is, to get 2019 compensation, or $15,385. So if the owner made more than $100,000 in 2019, then it becomes $15,385. But what if they only made $76,000 in 2019? Then 15.385% times 76,000 is going to be the amount of allowable, forgivable compensation for that owner. 24 weeks, 2.5 over 12. I don't know why we didn't stick with weeks and now we're at months, but we are. And so that number is 20,833. Cash. This is the cash compensation, non-cash compensation. Here's health insurance, retirement, and state unemployment insurance. State unemployment insurance in the CARES Act and in everything written about it is called state and local taxes. Well, that's not what we think of as state and local taxes assessed on the employer on behalf of the employee. And so finally, at one point in time, they came out and said it's state unemployment insurance. Okay. If you're a Schedule C or a Schedule F person, no, you don't get any forgivable cost for health insurance, retirement, or unemployment. If you're a partner, you don't get any of those costs. If you're an S Corp owner, employee, no health insurance, but yes to retirement and unemployment. If you're a family member of an S Corp owner, same rule. If you're a C Corp owner, you get it all. Then we have the little subscript 2. Retirement, I don't know why, is capped at either that 850 seconds or 2.5/12 of the 2019 retirement contribution. These kinds of things are why you want to just avoid owner's compensation if you can, because life would just be cleaner that way. All right, tax stuff, and then I'm going to stop because I think we've basically covered everything, even though there are more slides. The IRS issued a notice that said that you cannot deduct in your tax return expenses paid with PPP loans that have been funds that have been forgiven. So if you had a $100,000 loan and you spent it on payroll, now you can't deduct that $100,000 worth of payroll on your income tax return. If you're at a 25% rate, that means your income taxes just went up $25,000. Congress goes wild. That was not our intent. Boo, hiss. What were you thinking? There has been, from the moment that release came out until today, bipartisan, bicameral, meaning both in the House and the Senate, support for a statute that will correct this miscarriage of justice. Secretary Mnuchin also has the ability to change that notice, but has said simply that's what they think is right. That's where they're staying. there are dozens of bills, I think, that probably have this language in it to make those expenses deductible. Is anything going to pass before the election? Most people say no. Is anything going to pass before the inauguration? I don't know. And then last week, I guess, the IRS came out and said lenders shouldn't issue 1099s for forgiveness. On the tax front, this has made it really hard is estimated payments, right? You had to make an estimated payment September 15th. You have another one that you're probably going to make January 15th or maybe December 31st for Kentucky. And you don't really know what to do. And now, because of the great pace at which these forgiveness applications are flowing, you're not going to know. You probably will know by the time that you do your taxes, and you may have to extend. So this has been a sticky wicket. I bet I get asked by my colleagues every day if this is fixed yet. No, guys, not yet. All right, this is just this is the FAQs that we've already talked about. So yeah, you can read that. Some of these things were like, really? Remember we had the big debate on whether or not utility includes transportation, because in the first IFR, they said if you're self-employed, you could use the fuel for your auto that you used in the business. They clarify in these FAQs that is not what they mean by motor vehicle. That's not what they mean by transportation. I don't know where that leaves the self-employed person. We've already talked about reduction exceptions. If you got an EIDL advance, the amount of forgiveness calculated on the form will be reduced by the amount of that advance, and you will have to pay that back. If there's an amount that is due, if not everything is forgiven, the lender will notify you of the amount and the first payment date. Vision and dental benefits, I know you were dying to know, can be included in group health care benefits. Life insurance, accidental death and dismemberment, no. Related party rent. I was so upset. What was one of the earliest questions you had about this entire thing, about these loans? What about related party rent? I cannot imagine how many times I was asked, what about related party rent? Yeah, you can deduct it in an amount equal to, or included in an amount equal to the mortgage interest on the underlying property for the covered period. Well, what if there is no mortgage interest? Then there's no rent amount. Okay. SBA began accepting applications August 10th. They've got about 100,000. They haven't reviewed any of them, to our knowledge. There is promise of a second round of loans. Right now, there's numbers out there that it's going to require a decrease in revenue over year. The House says 25%. The Senate initially said 50%. Here's some cool links, and that's it. Hope y'all are all right.
That was a lot. I hope we switched to halfway through there, Erica. That is a lot. But you touch on a lot of things that people have asked, and we've got a ton of people out there from all over the country who are joining us today. And I'd like to quickly say hello to a couple of my business owner friends I saw on there. Trey Runyon and Sherry Hurley are out there watching today, and our good friends Benny Lopez and some of our SBDC folks. My good friend Sam Coleman from Middlesboro, Kentucky is here with us today. And we've got a ton of questions. So, I do have one question before we jump in. Well, actually I have two, but so in addition to kind of, working through your quarterly payments, I mean, what other tips would you have for business owners to prepare for a tax hit, to make sure they're in safe harbor? I mean, what would you advise your clients to do given all this uncertainty?
Yeah, so I mean, clients have been doing both things. So you have two options. You can calculate your estimate based on the idea that you're going to get no deduction. And that's the most conservative things to do because you're going to hopefully overpay at that point in time. or you can go ahead and say, I really think Congress is going to come through with this. Or, if there is an in-between that constitutes the safe harbor, Dave, you can make that payment.
Mm-hmm.
That's probably perhaps maybe the best of all the options.
It's worrisome for me because this was to help cash-strapped businesses, and it's a smack in the face going down the road. I mean, if I'm having trouble as it is now I have to start socking away cash for a tax hit. I mean, it's horrible.
It feels like a bait and switch.
Yeah, definitely. And I know you put a bunch of links in there. Is there a place where someone can get on the notification list so that you would know right off the bat on new FAQs and other notifications from the SBA?
Well, I did get on the SBA's lists. I haven't found a good way, Dave, to know. There for a while, we were checking every day. If there is an organization that you can belong to, if you're a restaurant, if there's a restaurant association, and I'm sure there is, that's monitoring this sort of stuff and will send an alert when that thing comes out. That's the best way. Another way, one of the guys was following Secretary Mnuchin's Twitter feed. I haven't gotten any notices from SBA about this, but you can go to SBA's website and sign up for notices. Treasury doesn't have something like that, and that's where most of it hits first.
Cool. So let's jump into some questions. So, hey, Tony, you want to give us our first question?
Sure, Dave. But before I start, Eric, I just want you to know that people are so grateful for your information. They've been saying wonderful information. And one lady in particular said, you are the PPP bomb. Okay, so just to let you know that.
Yeah.
So, okay, so I'm going to start with one from a lender. They wanted to know, why is the lender responsible for collecting the idle loan advance proceeds?
I think you need to ask the government that question. I saw that myself, and that wasn't part of the bargain either, was it? But I don't know I don't know. See, that's another bait and switch to me. That idle advance was supposed to be forgivable.
Yeah.
So by reducing the forgiveness, you're just making it a loan. That I don't know. Short answer. I don't know.
Well, okay, so maybe I want to go back because we had a lot of questions at the very beginning when you were going through your presentation. And so Julie, she asked if you could clarify the difference between the covered period and the adjusted covered period. Because she said when you were filling out the forgiveness application, the descriptions of each were identical. So she's trying to figure out what's the difference between the normal 8-week period rather than the 24-week adjusted period.
Okay, so nothing. 16 weeks is the difference between the 8-week covered period and the 24-week covered period. And that's just, and again, that was done as part of the Flexibility Act to allow businesses more time to spend their loan funds because they weren't able to spend it because they were shut down for so long in that initial 8 weeks. So that's all that is, Tony. Otherwise there's no difference.
Okay. Dave, can I keep going, or you want me to let you ask yours?
Yeah,
okay.
Go ahead.
Okay, so Larry wants to know, must you complete the PPP forgiveness form 3508EZ and submit to your bank before the 24-week period is up?
No, no, actually, good question, Larry. You have, for forgiveness, you have till last year on the loan. So let's say you just decided, hey, I'll just go ahead and start paying it. I don't know why you would do this, but the rules say that you can apply before you have paid off the loan. What you want to do is you want to apply in enough time that you get a decision on the forgiveness before your first payment is due. And your first payment of principal and interest on any amount that isn't forgiven is, well, you have to start paying 10 months from the end of your covered period. So you want to know what SBA and your lender have said before that 10 months ends.
Okay.
Hey, I've got a question here, Tony, from Krista. Hey, Krista. Missed you on our scale-up call this morning, but she wants to know, what if employees are on an annual salary and we don't count hours?
Yeah. So it's 40. I like that. I like that. You know, when it gets really hairy too is when you got commissions and tips and yeah, whoosh, yeah. But you just, if everybody's on salary, you've either got 40. I mean, you've either got 0 or 10. I mean, yeah.
On that, what about how do you calculate for commission-based employees?
Yeah. So there are, in that situation, you don't have hours on your payroll report, perhaps. How much that person, as the business owner, that Tony only works 20 hours a week because she has farm animals to take care of, and Dave works 60 hours a week because he wants to buy a new TV. So you're going to have to bring your independent judgment to bear there and proceed accordingly.
Okay. Dave, you want to go, or you want me to keep going?
Go ahead.
Okay. So this is kind of a twofold question. They said, how are benefits counted as cash? So health insurance or retirement?
They're not. Those are the non-cash compensation items. So they're counted as compensation. But the fact that they aren't part of gross wages is what makes them non-cash compensation.
Got it. Okay. How is I've gotten a few on the taxes. How is the PPP loan going to affect your 2020 taxes?
Well, it depends. Hopefully it won't. All right. We know that the loan proceeds are not included in your gross income. So that's positive. So if you had $100,000 of gross income before your PPP loan, you have $100,000 after. And what we don't know is whether or not we can deduct the $100,000 of payroll expenses that we paid with our $100,000 loan. We will probably know that before you file your return. If Congress reverses the action of Treasury / the IRS and says all of that is deductible, and it's in the Heroes Skinny Act that just came out, that the House Democrats put out this week. My friend on the call, he pointed it out to me. It's Section 203. I'm scared to read it because I'm scared to think about another set of PPP loans. But yeah, so it says that you would just deduct those as normal. So in that case, that would have no impact. If you don't get to deduct those, then depending on your tax rate, your taxes are going to go up by that amount.
So going back to the forgiveness portion, it says this person says their question is regarding owner pay limitations. Mm-hmm. They employ a spouse who is also an owner, and direct deposits are to a joint account. Would it be better to also limit this amount in their forgiveness application?
Well, so I've got a little bit of a mixed message based on what I heard, Tony. But if the spouse is an owner,
No, I'm sorry. It says they employ a spouse of the owner. I apologize.
They employ the spouse of the owner. Yes.
Okay.
So if we looked at that slide where it had who the family member was when we were talking about owner limits, flip. There are a couple of times when family members come into play. It depends on the type of business organization that you are. And so, for example, if you were a self-employed person or a partner, those nothing special is going to happen to that person. Family members of an S corp owner of an S corp are the ones that are limited, like the owner.
Okay. Can I keep going, Dave, or or do you have one?
I want to ask one.
Okay.
I get this one a lot. This is from Connie, and I've heard this also, that she's been told to kind of hold off requesting for forgiveness because anything can change in the future. And she also has a question about subcontractors, because I get that a lot as well. So what if you pay all subcontractors and you are the only FTE employee? Subcontractors are not FTE.
Correct. Oh, that's awesome. If you're the only employee, that FTE calculation is easy. I can help you with that. I can do that one.
All right, let's take a couple more there, Tony.
It's changing. I think the only thing that is going to change is whether or not there will be auto forgiveness at some amount for somebody. And so a lot of lenders have asked their borrowers not to apply if their loan was less than $150,000 for obvious reasons.
Mm-hmm.
And that's okay. You do what you want. If you don't like to have something hanging around your neck, debt in your mind or whatever, then maybe you go ahead and apply, because that's okay too. But that's the only thing I think will change in that regard. But don't hold me to it.
Yeah. So Tony, let's do one more. It's getting kind of late today, and people got to get back to work.
Okay. I'm going to try to make it an easy one, right? It says, if an employee is a W-2 employee, can they count this as cash compensation, or is this considered something special?
No. So let's just do that 1 second. So gross wages, which are typically reported for employees in a W-2, that is cash compensation. And that is the amount that you use for forgiveness, is that gross amount of wages or salaries. Non-cash compensation are the employer's share of health insurance, the employer's share of any retirement contribution, and state unemployment insurance related to a particular employee. So when a borrower is calculating compensation, or payroll costs is what it's called, gross wages for the employees, subject to the limitations for amounts over 100,000 and owners, are cash compensation and go on a cash compensation line. And then the employer share of health insurance, retirement contribution, and all of the unemployment insurance is the employer. It is what goes in non-cash compensation that are still part of payroll costs. Non-payroll costs then are your mortgage interest, your rent, and your utilities. So payroll cost has two components: cash compensation, gross salary and wages, and non-cash compensation, health insurance, retirement contribution, unemployment insurance. Employers cannot include their share of FICA or federal unemployment. Hope that helps.
Well, I just want you to know this. You all will get a big laugh out of this. Irma says, this event is more pleasant than last night's debate. Thank you, Erica.
Oh my goodness. I sure hope so. The little part of that debate that I saw, I don't even know, Irma, if I want to be mentioned in the same sentence or not.
Well, we better wrap up. It's 1:30, and Erica, it has been spectacular as always. You are just a fountain of knowledge, and I can't thank you enough for what you've done and shared with us today. And just a little reminder to everyone out there, you'll get an email from us with the recording and the files as well, so you can watch this over and over and over again.
OMG.
So.
Please get some medicine before you do that, guys.
So we're going to wrap it up from here in Louisville. So, Janet, any last words for us? And Tony?
I would say we would do like the teachers are doing with their students in their virtual learning. Let's like kiss our brain. It hurt today, but we learned a lot.
Or rub it.
All I have to say is everybody is so thankful. That's what I keep seeing in the chat is thank you, Erica. Thank you for everything. So thank you.
Yeah, thank you, Erica. Thank you, Janet. Thank you, Tony.
To allow more time for questions. I'm sorry about that.
Yeah.
Disappointed.
Well, with that, we'll call it a day. I'm Dave Etkin with the Louisville Small Business Development Center, and hopefully we'll see you next week. And good luck on your PPP loan forgiveness, and please reach out to us if you think we can help. So have a good week, and we'll see you next Wednesday. Thank you, Erica.
Thank you all. I appreciate it.